Like all other sectors and industries, the banking industry is affected by the recession. There has been a lot of discussion regarding the recession. It's widely believed that a recession has a negative impact on consumers in various industries. A recession is defined as a decrease in the stage of the business cycle. The authorized organization to announce that the global economy is in a recession is the National Bureau of Economic Research. Many individuals believe that countries with a healthy financial climate have strong economic growth. To understand the impact of the recession, we must first understand the financial status of the country's banks. Rather than investing in the cross-country influence of the recession, it's critical to understand the impact on a specific country. So in this video, we'll be discussing about the recession, its causes, and its impacts. What is a recession basically? A recession is a macroeconomic word for a significant decrease in overall economic activity in a particular area. It was previously defined as 2 consecutive quarters of economic contraction as measured by GDP and monthly indicators such as an increase in unemployment. However, according to the National Bureau of Economic Research, which legally proclaims recessions, 2 consecutive quarters of actual GDP drop is no longer considered a recession. Instead, according to the NBER, a recession is a major drop in economic growth across the economy that lasts longer than a few months and is reflected in real GDP, income, work, industrial production, and wholesale retail sales. Industrial production, employment, actual revenue, and wholesale retail commerce show signs of recession. Although the National Bureau of Economic Research doesn't require 2 consecutive quarters of negative economic growth, as calculated by a country's revenue to identify recession, and instead relies on more widely cited monthly statistics, quarterly GDP falls do not always coincide with the proposal to declare a recession. Causes of recession. Economic difficulties. An unexpected incident such as a natural catastrophe or a terrorist attack causes extensive economic damage. The COVID-19 epidemic is the most recent example. Consumer disappointment. When consumers are worried about the state of the economy, they limit their expenditure and save what they can. Because consumer spending accounts for about 70% of GDP, the entire economy could suffer a significant slowdown. High interest rates. High interest rates make purchasing homes, cars, and other significant purchases more expensive for customers. Because the interest expense is too high, businesses decrease their spending and growth objectives. The economy collapses. Deflation. The polar reverse of inflation, deflation occurs when demand for goods and services falls dramatically. Prices fall when the market falls as sellers seek to entice their buyers. As a result, people delay purchases to wait for reduced costs, resulting in a vicious spiral of less economic activity and higher unemployment. Current rate of recession. The quickest inflation in centuries and central banks' hurry to boost interest rates are creating recession concerns in financial markets, which are exacerbated by China's harsh coronavirus lockdowns and the Ukraine crisis. Inflation in the United States and the United Kingdom has accelerated at its fastest rate since the early 1980s. The central banks of Canada and New Zealand set an example for the United States Federal Reserve and others by raising rates 50 basis points for the very first time in 22 years. Bank of America Corporation stated that money managers were the most anxious about the economy's prospects. At the same time, JP Morgan Chase & Co. increased its reserves to protect itself against a downturn. Meanwhile, the UN warned of a perfect storm for developing nations as commodity prices rose. The World Trade Organization lowered its projection for trade and queries for recession on Google and the Bloomberg terminal increased. Policymakers will gather in Washington this week for the International Monetary Fund and the World Bank meetings against this backdrop. The fund has already stated that the war will cause it to lower its predictions for 143 economies this year, representing 86% of the world GDP. Bloomberg Economics said, "For the global economy, the combined impact of war and coronavirus will be a lower year of growth, higher inflation, and elevated uncertainty. To get to a recession, we need to see further shocks. Russia cutting off Europe's gas supply or China's lockdown expanding from Shanghai to other major cities is possible catalysts. However, there are reasons to believe that, at least for rich countries, resilience, although with a hint of stagflation instead of global recession, may be the rule of the day. As per a JP Morgan Chase research provided to clients last week, people in mature markets still have 11% to 14% of their income in savings, thanks to pandemic-era support. Leverage is at multi-decade lows and revenue is rising at a 7% annual rate despite strengthening labour markets, setting the stage for possible rebound in the second half of the year. Moreover, last week's figures on retail sales and consumer confidence in the United States gave hope that all customers aren't pulling back regardless of price shocks. "I see more reasons for the global economy to slow than re-accelerate," said Stefan Jen, who runs Horizon SLJ Capital in London. However, whether it will fall into a recession is a whole different story, simply because of the abatement of COVID around the world should unleash huge pent-up demand, helping to offset a good part of the headwinds. Nonetheless, such toughness will be put to the test. Many customers are already becoming irritated by the world's fastest inflation in ages, particularly those seeing increased food and fuel prices. According to a Harris poll for Bloomberg News, almost 84% of Americans plan to reduce spending due to rising prices. As a result, central bankers are also raising interest rates. The Federal Reserve is increasingly expected to increase its benchmark by a half point next month for the first time since May 2000, and begin decreasing its bond portfolio. Chairman Jerome Powell is likely to speak on the outlook in the coming days. One risk is that officials switch from responding too late to rising inflation to constricting too much when their economies deteriorate, or if inflation is fueled by supply chain issues that monetary policy cannot address. According to the fund managers polled by B of A, there is an 83% chance of a policy misstep. It's predicted that global growth will fall to 3.3% this year and next, contrasted to 5.8% in 2021, in advance of the IMF's new economic prospects, will be revealed later this month. It's expected that the large developed economies will grow slowly this year and deteriorate further in 2023. With India recovering and China grappling with lockdowns and a property collapse, the future for large emerging countries is divergent. The rapid rate of change this year has surprised officials. Last Monday, the White House economic advisor Brian Deese stated that the United States is facing a lot of uncertainty. Premier Li Keqiang of China stated that government stimulus is urgently needed. The state's dynamic zero approach to controlling COVID-19 has slowed output in manufacturing, and financial hubs Shenzhen and Shanghai and kept millions of citizens at home, has disguised a worsening downturn in China. However, this strategy is projected to decrease growth to 5% this year, much below the stated objective of 5.5%. If China fails to manage the virus currently, the global supply chains that are still healing from the outbreak may face a further setback. Giant Manufacturing Co. is one of the companies affected. Chairperson Bonnie Tu told Bloomberg Television that bicycle parts could take up to 2 years to arrive. Impact of recession. Educational accomplishment. Unemployment and financial losses can have a negative impact on educational attainment by jeopardizing early childhood nutrition and affecting families' and individuals' ability to provide a positive learning environment. Opportunity. The recession's job and income losses caused by the recession can have long-term effects on individuals and families. The rise in poverty that will come from the recession will have long-term impact on children and significantly harm the economy. Private investment. Through the second quarter of 2009, total non-residential investment was down 20% from high levels. For decades to come, the decline in investment will lower production capacity. Furthermore, because technology is frequently embedded in new machinery and equipment, the investment slowdown will likely hinder the adoption of innovations. Lastly, make a backup plan for what would happen if you lose your employment. So grab a new talent while also building up your emergency fund. It's natural to be concerned about the future when facing a recession, but protecting your assets can make you feel more secure. So people, concentrate on that. We want to hear from you if you think we're heading towards a recession and why. Leave your response in the comment section below and we'll be sure to get back to you. Please leave a like and subscribe to our channel if you enjoyed this video. Click the notification bell to never miss out on future ones. Stay tuned until the next video. We'll see you soon.